Impulsive investing is very harmful for your portfolio. Are you looking for a cure? Watch this video where I speak about 4 to 5 different ways in which you can avoid impulsive investing. Last week, I was watching a football match with my brother and his friends. They're all big football fans. And during the match, there was a penalty awarded. Now, these group of people started discussing on which way should the goalkeeper go? Should it be left or right? Which I just told them that I read somewhere that 28% of the time the striker hits straight. So why doesn't the goalkeeper just stand straight without moving anywhere? To which one of the guys said, no, that will look very dirty and ugly. Just imagine you standing straight like a statue while the ball goes left or right. He has to show some action. Incidentally, that very same day, Ronaldo of Manchester United hit bang straight while the goalkeeper moved to his left. There was a stunned silence in that room. This immediately though reminded me of all of us investors. We are always in search of some action. We want to do transactions in our portfolio. We want to exit high, wait for some time, wait for the markets to correct, and also want to buy low. We want to time the market. We want to do a lot of things. Fundamentally, exiting high and buying low is the best thing to do. There is nothing wrong in it. But practically, mentally, it is impossible to do this on a consistent basis. You need to have a framework. You need to know a reason for taking a certain transaction in your portfolio. I came across a very nice article by Larissa Fernand of Morningstar, and I thought I should talk about a few of the points that she has discussed in this video. Watch till the end, which will help you cure your disease of impulsive investing. One of the key changes that you need to bring in with immediate effect is to change the way you look at that particular company. Remember, you're not investing in a company because you expect the share prices to move up and down. If you do so, you're not an investor, you are a trader. As an investor, you believe in the business of the company. The management will bring in a lot of changes that will lead to earnings per share increase, that will lead to market share expansion. And you also believe that that particular company is in a sector that is growing. If you think that the businesses will do well, which will in the end lead to share price change, you will invest. Now, let's assume you brought in this change. Your perspective of that particular company's share price fall or rise will immediately change. Let's say that company's share price fell off. Instead of worrying, you will start analyzing, is that particular fall because of the company's poor performance, or is it a generic market fall issue? Let's say if it is a generic fall, then you will actually double up. Or if it is due to that particular company's poor performance, then you need to keep a red alert on that stock. Therefore, my only request is change the way you think about companies. By now, we all know how a bear market, a bad market, a falling market looks like. It creates a lot of panic, and we are in that kind of a situation today. You go to any social media, you will see some live telecast where people are talking about how badly the market can fall or what could be the bottom. Everyone wants to know, what should I currently do with my holdings? Should I buy, sell, hold? While on the other hand, when the market is on a roll, you throw away the caution to the wind. You're not worried about any kind of a warning sign. Fear sells, excitement buys. To be honest, everyone goes through this particular period. Everyone has this negative energy when the market falls. Instead of ignoring it, you should channelize this to a different direction. You would have at some point in time shortlisted a set of stocks and funds that you wanted to buy but thought it was expensive. And today when you look at it, it may be cheap. So instead of worrying about the market falls, you should just look at those fairly attractive companies and invest your sum into those kind of companies or funds. While on the other hand, when the market is on a roll and your positions in a certain stock or a mutual fund or different kind of an asset becomes big, all you need to do is asset allocation. What's the point of being rich when a certain asset creates sleepless nights for you? So instead of worrying too much, all you need to do is prune positions to a comfortable level that will lead to good, peaceful nights. Asset allocation during bull market, looking at falling companies with great valuations during bear market is something that will help you to go through these periods of ups and downs pretty smoothly. Do you have control over the Punjab elections or UP elections? Do you know the next CM there? Do you know how well the Indian GDP will grow this year or the next year? Do you have control over that? Forget everything. Do you know what RBI governor will do this very same week during this monetary committee meeting? We don't have control over all these. So let's not sweat over it. We should rather focus our energies on things that are in our control. Your savings rate is in your control. You can increase it if you want to. The asset allocation that you want to follow is in your control. Return expectation is well under your control. The kind of goals that you want to set is in your control. Let's rather focus our energies on these things that are in our hands than worrying about outcomes. And there are people who decide to switch assets, who decides to switch market caps or move from equity to debt basis economic conditions and political results. Please try and understand. Buy, hold and exit strategy has got better track record than market timing at any given point in time. So let's not waste our energy trying to time the market. Rather, let's be in it for as long as we don't need the money. Finally, one thing we need to understand is that everyone in this field is playing different games. You may be playing a long-term game and I may be playing a short-term game. But if I'm trying to play your game, I'm fooling myself. I understand that you may have a certain way of growing your wealth, but that may not be really applicable to me. I'm just going to enter into a fund because I expect 15% return in that year. If you've done it and you want to exit, please don't listen to the other guy who says, no, this will go to 16, 17, 18%. You should just exit. You entered a game to win it. If you've won it, just put a full stop to it. Primarily, I may not be a big advocate of exiting. If it suits you, so be it. At the end of the day, it's your money. Therefore, my suggestion is consult a good investment advisor who will help you build plans, build portfolios for various investment plans of yours, which is not generic but customized especially for you. Good luck.